Morning, folks. Just give me a wee second to change a couple of settings. Okay, so we have a few people have joined. I think we had 16 people altogether had signed up for this morning's or today's webinar. Probably there usually has a few drop-offs whenever you run events like this online, but we have a few people have come in now, so I'm just going to kick off anyway. First of all, thank you very much for joining us today for Cloud 360's first webinar of the year. And this is Know Your Numbers, and I've chosen it specifically because it's a good one to get started with in terms of some of the basics. And it's to help people, and I know there's going to be some clients that are on the webinar today, and there are going to be some other business owners on the webinar today. So it's to give you an understanding of what your accounts and your financial statements are all about, trying to get a look at it at a really basic level. And also to give you an understanding of why knowing your numbers and understanding them a bit better is something that you should be doing, should be aiming for, because it can improve your overall business results. So that's the aim of today. I will keep it as jargon free as I possibly can, albeit there's normally going to be some jargon when you're talking about accounts and financial statements, but I'll explain things as we go through it. And hopefully then you can get a better understanding. There'll be a wee bit of time at the end for some questions as well. So let me just go through now first of all and get started. And what I'm going to do in the first instance is I am going to share my screen. So bear with me for a wee second. Okay. Share screen. Okay, perfect. So hopefully that is coming through for you all now. So today's Know Your Numbers webinar, what's it all about? Presented by myself, who most of you can see on the webinar at the moment will know me. And for those of you who don't, I'll do a brief introduction as well. So today I am the presenter and moderator of the webinar. Presenting today's topic on behalf of Cloud 360 Accounting. I'll also be managing some of the webinar questions that come through and just oversee the running here in the background. So I'm probably doing about 3 things at the one time. So if I start to ramble at any point in time, you'll know I'm trying to manage a couple of things at the one time. But for those of you who haven't met me before, my name is Kieran Phelan. I'm the CEO and founder of Cloud 360 Accounting. But a little bit about us for those of you who don't know about Cloud 360 Accounting. We started our firm in 2010, and we were the first cloud accounting business in Northern Ireland. And I was the first ever Xero certified advisor in Northern Ireland at that point in time. Since then, cloud accounting has become a lot more mainstream. Certainly in its early days, I was the only one doing cloud accounting and digital technology for 2 or 3 years before a few other accountants in Northern Ireland started to get into this kind of sector. And why did I get into that sector? Well, mainly because I've been working with other accounting firms sort of for the previous 15 years. So I've now been in the accounting practice space for 26 years. And during that time, working with clients was all about getting the client to give you information. And it was all manual, it was all bags and boxes and all that kind of stuff. And I discovered a piece of software even before I saw Xero, which seemed to cut out a lot of the collecting of information on that sort of basis. And Xero then came along with their bank feed technology, which connects your bank account. And one of the big things for accountants and bookkeepers was getting bank statements from your client. This cloud technology and Xero and everything it brought was solving that problem. So that's why I went and formed Cloud 360 Accounting way back in 2010. This year, we were awarded at UK Small Firm of the Year 2021 by Xero, which is a massive achievement for us. That's a UK-wide award and places us in the top 3 in the UK, and then we won the award. So that puts us ahead of everybody else in the most hotly contested category in the UK. So that's beaten, there was nobody else in Northern Ireland or Ireland in that category. There was firms from all over England, Scotland and Wales. So we're very proud to achieve that, especially based on the year that we've had, I suppose, over the last 12 months. And what we've been doing over that 12-month period is helping to support a lot of clients through the coronavirus pandemic and pointing people in the right direction and giving them a sort of leg up to get various bits of financial support. Overall, what we do at Cloud 360 Accounting, yes, we are an accounting firm and a bookkeeping firm, but our main objectives in doing all of this is we want to help to systemize and automate your processes within your business. And the aim of that is to free up your time from maybe doing stuff on spreadsheets or having to chase around and gather up receipts on a sort of very manual labor type basis. So we want to free up your time. We want to help to kill the overwhelm that's involved in running your business and understanding your financial processes. We want to help people to build an empowering mindset because I'm a great believer that your mindset will dictate how your life and your business will roll out. So there's certain things that we do in terms of helping to coach and mentor clients along that basis as well. And overall, we want to help people to grow profitable businesses, no matter what their overall objectives are. You want to you may be a startup, you may want to keep your business very small, but you want to be able to grow it to give you an income that you deserve and do it on a profitable basis. So our 4 key objectives is make more money, save time, better systems, peace of mind. Those are 4 hashtags we use in a lot of our social media stuff. And that's the objectives we have when we're working with clients. Just a wee bit about today now, the audio settings, if you are having any trouble with it, are down in the bottom left-hand corner for Zoom, so you can test your speakers. There is a Q&A button at the bottom, where if I am going through anything, please drop a question in there. I'm going to try to finish up at around 10 to 1, so I can jump on some of the questions if anybody has any. And then you've got your leave meeting. If you need to leave early, you can leave the meeting down the bottom right-hand corner, and this is being recorded anyway, so you can certainly leave and rejoin with the link, but that's how you can exit and enter the meeting again. So just to start things off, the thought for session today is something I just wanted to share with you. Budget is not just a collection of numbers, but an expression of our values and aspirations. Quite a lot of business owners that we speak to when we bring in new clients, even existing clients that we're working with, don't have a budget in place for their business. And for new clients coming to us now, it's something that we actually insist on because it's such an important and valuable tool, and it's an important and valuable exercise to do. A lot of business owners will create a budget for a particular purpose. So you might be going for some kind of funding with Invest Northern Ireland, for example, or you might be going for some finance with your bank or another funding source, and they will ask you for budgets and forecasts, and then you'll sit down and do this exercise, and it's only done for the purposes of a tick box exercise. But in actual fact, here at Cloud 360 Accounting, and I suppose if I didn't do this, it would be a bit rich me trying to teach everybody else to do it. But like I sit down on an annual basis in January and do a budget for the entire business for the year for us in terms of, what's our income level is going to be, what money are we going to be spending, what's our staff levels, what's our premises costs. So we do that on an annual basis, and that's because it's about taking your business to where you want it to be. That makes it such a useful exercise, not just filling out numbers or filling out a spreadsheet. How much profit do you want the business to be earning? How much taxes are going to be to pay on that profit? What ways is there to save some tax or to save some money on the tax side of things? And how much do you want to be earning from the business this time, 12 months time? Or even if you project forward in the future for 2, 3, 4, 5 years, it really is an important exercise to be able to build the type of business that you want and deserve for the effort that you're putting into it. Hopefully you've all prepared some kind of budgets or forecasts given the onset of the pandemic way back in March, April last year. Now is the time to make sure you understand those. You want to be able to monitor and measure how you're doing against your budgets, and I'm going to cover some of that today. We want to demystify the common reports that you're going to see from your accounts, and you should be seeing these on a weekly, monthly, quarterly, annual basis. But for most people and most business owners that we deal with, certainly monthly, and no less than that. We do have some people who might want to look at things quarterly. But if you're only going to look at your numbers with your accountant on an annual basis, you're missing out massively. And it's already too late by the time that you're looking at those numbers to make any effective changes. You can change the past for a start, but you want to be able to look at these numbers regularly so that you can actually change things within your business on an ongoing basis, which will impact on what your bottom line is. Just a quick word, I suppose, on overall on budgets. Look, if you think about preparing a budget, I always compare a lot of things to long distance running. I used to do a bit of long distance running a number of years ago. I used to run with Foyle Valley Athletic Club. And if we were training for a marathon or a half marathon, you sat down with the coaches at the start of a 3 or 6 month period, and a training plan was decided as to what was going to be done over that period for the entire group. And then for individual segments within the group, what kind of pace everybody needed to be running certain things at. That will be the equivalent of preparing a budget. So what I would also compare is that if you're not actually looking back at your budget, you're not actually recording how you're doing in terms of your business. That will be the equivalent of not actually turning up to your training sessions for your half marathon training, or not doing any running at all, but continually just maybe looking at the overall plan or budget and on its own. You've got to be able to revisit this on a regular basis. And that's where we can come in as well. We can help with setting up Xero to get your budgets in Xero, to get reports out of Xero so you can compare how you're actually doing as well. So you've got to make it a sort of moving, fluid thing that you're doing. It has to be part of your business processes. So over the next sort of 45 minutes, I will cover the importance of knowing your numbers, an overview of the different reports that you should be producing, the difference between profit and cash. That's a very important element, and it's one of the main elements that I see business owners, especially small business owners, getting quite confused about. So I'll cover some of that today as well. We want to talk about the key drivers of business value and also adopting best practice, some things that you should be doing within your business on a regular basis. We'll outline some potential next steps for you to make sure you can truly understand your numbers. Look, I would recommend you take some notes today. Some of what we talk about might sound a little bit like a foreign language at times. It could be accountanese or whatever you want to call it. But look, send through your questions in the Q&A and I will cover those off towards the end of the session. So why do you need to know your numbers? Knowing your numbers is vital, as it allows you to interpret reports, knows if you're on track to achieve certain goals that you might have set out in your business plan or your budget or your business recovery plan. But my top 6 reasons for why you need to know your numbers are laid out here, as you can see on screen. So they tell the story of your business and allows you to interpret the results of business activity. Generally speaking, looking at your numbers will tell you how your business is doing and where your business is at. It also helps identify the symptoms and root causes. So for example, if there's a decline in what's called your gross profit, that's a symptom of many root causes, such as like ineffective pricing, having to rework, remanufacture, poor purchasing techniques, possibly too much wastage. There's always a deeper issue and a deeper problem. And the importance of knowing and understanding and spotting this within your numbers is so that you can go to the level below and find out, right, okay, what's actually causing it and what I need to do to fix that. Knowing your numbers is going to enable you to spot an early warning sign of potential issues. So for example, if you monitor how long customers are taking to pay you, then you can easily deal with improving that number. Wherever you see certain customers are not complying with terms and conditions, and you can strengthen your terms and conditions. You can add in a payment service, which is the likes of Stripe or Go Careless. We can integrate that into a Xero system for you to allow people to pay you faster. Other things as well where you need to know your numbers is the areas of strength and weakness will be highlighted when you're looking at your accounts and your reports. So looking at your balance sheet, which I'll come on to in a later slide, is going to tell you, is your business value actually going up or down? What's impacting on those figures? What's making it go up or down? Understanding your numbers also means that you're going to have reliable financial information to base your decisions on. And I've got a sort of interesting slide next to really qualify that statement as well. Finally, look, knowledge is power. Whatever you can measure, you can manage, and that means you can change things. And that's the importance really of the whole session here in terms of knowing your numbers. Look at the numbers, know what you're looking at, get an idea of what they mean, and then you'll be able to understand what you can do to change those numbers in the future. So this additional slide I've sort of just put on this morning now, newsflash, that it's all about having up-to-date, accurate and complete information. Because when we implement the likes of Xero as the central accounting platform, and we implement processes where either we're doing the bookkeeping on behalf of a client, or we show the client how they can do some of the bare essentials. Then you can run reports from your accounting system to see how's the business doing, how's it performing, where's it at today. Now, if your information is not accurate or it's not complete and it's not up to date, then it's a garbage in, garbage out situation. You could be looking at numbers which don't make any sense at all because they don't have the complete information. So the books must be accurate. That means the basics must be 100%. For example, your bank balance within your accounting system has to be 100% accurate. Your customer balances have to be 100% accurate. Your, bear with me just a wee second. Your supplier balances have to be 100% accurate. And there's no sort of getting away from that. That is an absolute must. Your books must also be complete. So why would you tell yourself only part of a story? You know, I've had conversations with clients in the past where you discover that there's maybe some things in the books and records that shouldn't be in there. Some stuff, I mean, I've had conversations with clients in the past. Can I buy such and say it's for my business? I suppose you can if you want. If it doesn't make sense, it doesn't matter what your receipt says. You know, had somebody looking to buy a bed for the business for, you know, well, I need to take naps during the day. You get all sorts of crazy stories when you're doing what we do. But if it doesn't make logical sense and it's not allowed by the tax rules, there's no point in doing that. Plus, why would you get a set of reports out which contains this type of stuff in it? It doesn't really tell you how your business is really doing. Really what you want to be looking at there is, okay, if you need to buy some stuff like that, you need to be earning more money out of the business. Let's look at a tax effective way of doing that instead of doing something like putting things like that through your books and records. And it's no secret as well, you know, you will have some businesses who maybe not want to put through all of their income if there's some cash-based stuff there. But again, look, it's a complete false economy. You're just actually trying to kid yourself. You're lying to yourself. And in actual fact, there's probably more effective ways and legal ways of saving tax than getting into that type of stuff. Books must be up to date at least weekly, if not daily, and that's what we're doing for many clients now. So all of these things together can make sure that the reports you're going to get out of your accounting system are accurate, complete, and up to date. Okay, so overview of the key reports that we're going to look at now is going to look at each of these reports. We'll work through examples, show you some of the key learnings and things to look out for in your reports. We're going to use a fictitious company called Foods Company, just for the purposes of these examples. So key reports we're looking at now is going to be called trading account, profit and loss, balance sheet, statement of change in equity, or that's for a limited company, or if you're not a limited company, it's called your capital account. And then you've got director's current account for limited companies as well. So that is very jargony, but I'll hopefully break it down a wee bit more as we go through the session. Okay, so what's your trading account? So your trading account in your accounts and in your financial statements that your accountant does for you, or that it's going to be held within your accounting system, such as Xero. It tracks your sales, tracks your variable costs, and looks at your gross profit to calculate how much money are you earning from the sales that you're achieving before you take off all your fixed costs, which is called your overheads. Okay, your gross profit percentage measures what the margin is. Is it improving? Is it deteriorating? And that can then make you ask the question, why is it happening? If it's improving, it's a good thing. If it's deteriorating, why is it happening? I spoke to a client even last week whose margin for the last sort of 2 years had been increasing gradually. And over the course of the last year has taken a massive dip. And when I raised the question, like, why is that happening? A lot of answers now are based on, well, that was the pandemic. If it's coronavirus, everything that happened, you know, everything's kind of gone up the left. The truth of the matter is that's not the case, in my opinion. Figures within your business are affected by decisions that you're making. So if the business owner, because of the pandemic, has adopted a mindset of panic and fear and decided to try, I'm going to discount some of my sales products, or if they've discovered that the stuff that they're now buying in has for some reason crept up in price and they haven't put that extra price onto the sale price of their products, that means that their gross margin has gone down. So I wouldn't say it's to do with the pandemic. I would say it's to do with the decisions they've made as a result of what way the pandemic has made them feel emotionally as opposed to the start of the period. You can track your results across different divisions within your trading accounts as well. So if you've got one or two different shops or one or two different locations, then you want to be able to track how each one of those is doing. Small adjustments within your trading account and within the transactions that lie behind your trading account can really have a massive impact on your overall business performance. And I've seen business owners because I've been doing this for 26 years, when they struggle, they look outside their business for what the problem might be, whereas in actual fact, the problem lies within their business, which is a good thing because it's easier to resolve. So some business owners would say, I'm not making enough profit. I'm struggling to take a wage home. And sometimes, I've had to pay tax, so that's really made me struggle. The problem is never the surface problem that's described. It's always a deeper problem. And when you can dig down into your figures and figure out that actually the stuff that you're selling, if you're doing stuff like discounts, that's what's affecting and causing the problems. And this is the type of stuff you can find from looking at your trading account. So here's an example we're just going to look at now. Foods company, this is their trading account. And their trading account shows they've got sales of just over 1 million. So that's the starting point. This is what you'll see at the very start of your profit and loss report when your accountant gives you. What was your sales for that 12-month period? The next figure you'll see is cost of sales. And in the case of this company, Foods Co. have cost of sales of 318,000. Now, cost of sales in the trading account is how much did the stuff that you've sold, how much did it cost you to buy? Roughly speaking, if you're buying, if you're running a business and it's product based, then that's the cost of the product you're buying in. You adjust it for how much stock you have at the start and end of the period. That gives you the cost of the stuff that you've actually sold. If you're a service-based business, sometimes you won't have any cost of sales unless there are things in there like maybe hosting fees, for example, if your recharge goes out to customers. So you may not have actual cost of sales, you may have what's called direct costs. And that's the next part of this trading account. So you've got direct costs there of just over 450,000. So not just the cost of the products themselves, but the cost of actually getting the product into your business. And actually, if you've got to dispatch them out to your customers as well. So in this case, they've got delivery costs. They've got direct wages because they are, I think, manufacturing and preparing food-based products. So this is the cost of the staff making the products that they're selling. They've got packing materials. They've got sales commissions and bits and pieces like that. So you've got your sales, you've got your cost of sales, you've got your direct costs. So when you take your sales minus the cost of sales, minus the direct costs, you get your gross profit. And the gross profit is one of the most important figures whenever you're looking at your accounts. It will vary in line with your turnover. But what you want to be measuring when you're looking at your gross profit is what is the gross profit percentage, or what's your margin. For anybody who's used to watching the likes of like BBC Dragon's Den, you will hear the Dragons talking about this constantly when they're looking at figures. What's your turnover been in the last 12 months? What's your turnover going to be in the next 1, 2, 3 years? What kind of gross profit are you achieving? What's your margin? It is the one figure in the accounts that means so much more than everything else, because it will drive everything in terms of the quality of your business, probably the quality of your life as well. As you can see, this business is earning a gross profit of 24%. Now, let's just say, for example, now you don't know what these numbers are and where they're coming from and what they mean. How can you change these numbers? So if you work with ourselves, for example, and we can do coaching and mentoring exercises and data analysis with clients and customers of ours. And let's say what we identify then is that there are strategies to maybe increase your prices. Now, some of these figures are probably a little bit on the high side, but it's only for the purposes of example. But let's say you've got a chance of getting your sales prices up by 10%. And let's say we also look at some of the stuff that you're buying, and working with us, we can find ways that you can buy stuff a little bit cheaper. You do your own research and decide actually there's suppliers doing the same type of products, but doing them a little bit more cost effective. So if you do that exercise and working with the likes of us to do that, maybe also you can renegotiate, for example, something like 10% then, if you look at your prices, maybe you can change your prices and put them up without having a massive drop off from customers. Or maybe you can just retain customers on a better basis than what you're currently retaining them. So customers come back to you much more frequently than they currently do, or they refer somebody else to come to you as well. So maybe you should have some kind of referral system in your business to get your sales up. If you can actually buy stuff a little bit more cost effective and maybe save 5% here, and let's say as well, you also look at, for example, renegotiate the contract with one of the delivery providers in terms of those 109,000 of delivery costs. And let's say you manage to save 5% cost on that as well. So understanding your trading account now, what you will see is this is the impact of it. So if the sales manage to go up by 10%, then that's an extra 101,792 into your business. 5% saving on your cost of sales, on your cost on your purchases, could earn you just under 16,000 by doing that exercise. Maybe looking at some of these direct costs, and in particular in this example, we're saying maybe the delivery cost can be renegotiated. So that would earn the business an extra 22,500. So overall, what happens is the business has gross profit up to 389,000. So I know they're not massive percentages, but even with small percentages, you're going to add money and numbers onto your gross profit. And look at the change in the percentage. The percentage is changing to 35%. That's up from 24%. Those are fairly big figures, I suppose, at 10, 5, and 5. But even if you do sort of 3, 2, and 1, you will see a change in your gross profit, and that will go straight on to your bottom line. All right. So hopefully that gives you an understanding of what is the trading account, what does it mean, and what's the importance of it? Like, what can you do with this? So the key message I'm giving you there, folks, is that if you want to change your life, you can start by changing your business. And if you want to change your business, change your numbers. All right. So moving on through some of the other key reports and what they mean. When I talk about cash now for the rest of this webinar, I'm not talking about what we see on the screen at the moment. All right. Cash, when I mention cash, is not actual pound notes and coins. When I say cash, what I'm talking about is money in and money out of your business. Okay. Generally, that'll be through your business bank account. And of course, we always advise clients to make sure that even when you are dealing with cash, lodge it all to your business account. If you don't lodge it all, record what you're doing with the money that you're not lodging, because you could be missing out on expenses and stuff as well. But look, for the purposes of the rest of this webinar, when I say cash, it's not what you see on that slide. Okay, next report then is the profit and loss. Okay, profit and loss, also known as an income statement, and it shows you what your earnings and costs are over, generally speaking, a period of a year, and tracks what the overall performance of the business is. So, and it also matches income and expenses for a period. So for example, you may have sales in your profit and loss account, but you haven't got paid for them yet. But because you actually sold the goods or delivered the service in a certain period, then you'll have sales in your profit and loss account for that transaction. Profit is not the same as cash. Profit and loss account will include non-cash stuff, such as like depreciation on assets. That's something your accountant does a bit of an adjustment for at the end of the year. Depreciation on assets is if you own like a fleet of vehicles, or you've got office equipment and computer equipment, they tend to lose value every year, and there's an entry in your accounts called depreciation, which is simply a reduction in value. So it's not money out of your bank account, but it is a cost to the business. The reason it's a cost to the business is because at some point you're going to have to actually replace certain assets. So every 3 or 4 years, you might have to replace computer equipment. You know, every 4 or 5 years, you might have to change the van or a car. And depreciation just measures that there's an annual cost involved. And it's almost a case, I mean, the way I describe it to clients as well is that depreciation is something that you probably should, whatever the figure is, set that money aside every year so that you can actually buy assets. So the profit and loss is really just a framework. You can benchmark your results in your profit and loss account by using percentages or comparing between years to compare your business to performance for similar businesses. So think of your profit and loss account as how are we doing? Okay, how is the business done between 2 certain dates? A lot of business owners see their account once a year, so they look at how have we done in the last 12 months compared to the same period for the previous 12 months. But really the profit and loss account can be a fundamental driver of the value of the business, depending on how much profit you're making. If you're making profits on an annual basis, it's going to increase the value of your business. So here's an example that we have in relation to profit and loss account now for Foods Co. So this comes below the trading account. So you'll have your sales, your cost of sales, now you're at your gross profit. And as you can see here, we've a loss situation in this business. So the gross profit was 248,000 towards the top of the slide. The total expenses that this business has is 362,000. So it's actually losing just under 114,000 a year. But let's look at some changes. So if you undertake a review of certain expenses, okay, and let's say you go and try and find a cheaper insurance quote, and that saves 5% on your existing insurance. Let's say you go back and negotiate with your landlord and get a 5% rent reduction for a period of time, okay? So what does that mean? So you will have saved £597 there on your insurance. You will have possibly an increase in maybe accountancy fees, which will include coaching and mentoring services. And we've done this with clients whereby they double kind of what they invest with us. And what they do with that extra money is start to do an exercise like this on their numbers. And we come up with strategies whereby they can actually make changes to the numbers. So in this case, for the example of Foods Co., they used to spend $4.5 grand a year with their accountant. They decided to spend 10 and get this exercise done. So they've spent an extra 5.5. What have they done? They've saved 597. They've saved on the rent by maybe having some kind of involvement with the likes of ourselves on that exercise. But they've also, don't forget, increased their sales, and they've decreased some of their cost of sales. And overall, what that means is that as a result of all of that, the business can turn from a loss of 114,000 and it's up now to a profit of 138,000. So overall, that's a positive result. And that's why knowing your numbers and taking action to change your numbers is something that's absolutely vital for your business and something you just have to do on an ongoing basis. Okay, so the next report we want to talk about is called the balance sheet. You might have heard myself or your accountant talking about the balance sheet and wonder what the hell is a balance sheet. Well, a balance sheet measures the net worth of the business, and that's what the assets are minus the liabilities, and it shows you if the business is what's called solvent. Solvent means it's able to continue to trade and it's able to pay the debts that it has whenever they fall due. You can compare on your balance sheet different periods to determine if the business's net worth is increasing or decreasing. The stronger balance sheet that you have, the easier you're going to find it to survive whenever there's a downturn. I think we all have experienced this in terms of the last 12 months. And this is why we aim to work with clients on a more regular basis to monitor and measure your numbers and spot the early warning signs that something needs to be changed or addressed within the business. Hopefully one of the lessons a lot of business owners have learned in the last 12 months is that you really should be setting money aside after you pay yourself. You should be setting money aside to pay your taxes. You should also be setting some kind of extra sort of savings fund aside. Now, for a lot of business owners will think, well, I just don't have enough money coming in to be able to do these things. So my question would be, what are we going to do to make sure that you do have enough money to do these things? Is there some kind of cost review can be done? Is there some kind of review of your sale pricing, your sales strategy, your marketing strategy to get more customers? There are always things that you can do to change your position. And when you change your position, you change the position of the business, which means your balance sheet gets better. So the net worth of the business is better. Think about your balance sheet as where are we now? Because it only looks at the business on a specific day, which is generally your year end, but it's where are we now? So we're going to look at the example for Foods Co in terms of their balance sheet. A lot of information, folks, on that slide, a lot of numbers, but let me just pick out some of the key numbers for you to let you see what is involved. So first of all, we want to look at the current assets figure, 138,475. Current assets is how much money have you got in the bank? How much money are you owed by customers? How much money have you got tied up in stock? That's what you're essentially speaking what your current assets are. The next figure we're going to look at is current liabilities. Okay, that is how much money do you currently owe other people that you've got to pay off in the near future? So you might have an overdraft with your bank, you might have a credit card, you might owe some VAT, you might owe some money to suppliers, you might owe some money on hire purchase or leases, which has to be paid over a period of time, but there'll be part of that will be repayable within 12 months. That's your current liabilities. And what you can see for this business is that they have current assets of 138,000 and current liabilities of 162,000. What that means is that this company has a solvency issue. It has a working capital problem and will probably always find themselves saying, I've got a cash flow problem, I've got a cash flow problem. That's what these figures are telling you. So if you know you can run your balance sheet, which you can do on zero, and you see something like that, now's the time to take action. That might just be lifting the phone to the likes of ourselves. They say, what am I going to do to change this? But it's good to be able to look and see what are those two figures. And if the current assets is not more, if it's less than the current liabilities, you know you've got an immediate problem. Overall, what we're seeing here is that the net assets of this business, as you can see, this business has quite a lot of loans down below in non-current liabilities, like £691,000. And that's probably loans that it may be used to buy property or plant or equipment as well over at a point in time. But overall, what we're seeing here is that the balance sheet for this business has a minus 305,000 figure on it. That means this business is struggling. It means it's in negative equity. And what can we do about that? Well, there's other things that we can measure on this to see what it tells us. So for example, let's look at the money owed by customers, which is called trade debtors. And we can do a wee quick calculation here, okay? To calculate your debtor days measures how long on average is it taking customers to pay you, okay? And in order to measure that, what you do is you take how much money are we currently owed, divide it into your sales figure and multiply it by 365. So this business is on average taking 26 days to get paid by its customers. And if you decided there was a way of improving that by say 5 days, that can actually generate an extra 14 grand into your bank account. Now it doesn't solve the solvency problem, but it does mean you're getting paid faster and you have more money going into your bank so that it does take the heat off the business. If we look as well at inventories, so that's stock, how much stock have you got sitting unsold at this point in time? And in this case, it's 64,953. You have to divide that into your cost of sales figure and your profit and loss, multiply it by 365. And what does that tell you? It tells you that it's taken about 74 days from the time this business buys stock from the time it turns into a sale, which is quite a long time, okay? You're talking 2.5 months there from when something's bought to when it's sold again. And if you think about it like this as well, folks, if it's taking you 2.5 months plus an extra month, that's 3.5 months that you're out money before you get money back into your account in a sale. So that's quite a long cash turnaround time. Does that make sense, hopefully? Let me just go back there a wee second. Okay, so just before I finish on that, I want to talk about a couple of strategies there that might be possible. So overall, this 14,000 here in customers paying you quicker, and this 9,000 here, if you're able to, for example, change some of your buying policies and payment policies with creditors, like that can give you an extra 22 grand in your bank account. Won't change your overall position. You need to look at the profit and loss account to change the profits of the business. But there's ways of actually generating cash faster. And that's the type of stuff we work with in terms of working with businesses, especially using digital technology to do that stuff. Right, okay, statement of changes in equity for a foods company. What this shows you is it shows if profits are paid out as dividend or are they still within the business. And it captures a rough book value of the business and shows if the company is solvent. So we'll look at this briefly now for Foodsco. So you can see here, the company has accumulated losses for at least the last 3 years, I would say, because what you've got here is a minus figure within your equity. That means the business has been consistently losing money and it's currently and has been insolvent for a while. Doesn't have any money to pay out dividends, and the owners are probably feeling stress and strain, and there isn't any money to reinvest and maybe buying new assets. Again, this is causing the business owners to feel some stress and some strain. The directors have to take some kind of action to make sure this business turns around from being loss-making to profit-making. Okay, the next report in terms of knowing your numbers is called the director current account or director's current account. This is applicable, folks, for limited companies. And what this records, you may hear your accountant talking about this, is all the funds introduced to the business by directors or taken back out of the business by drawings. Now, when you're a limited company, there's different ways you can take money back out when you're a director. Number one, you can take a salary. Two, if you're also a shareholder, you can take dividends. Or number three, if you've put money in to start the business, you can draw back out against that through your director's current account. All right. It'll help you monitor personal expenditure from the business because it does happen. We have to be realistic about this. Even myself, I've got the odd thing from Amazon because when you buy it from Amazon, it's going through my business and I just record it against my director's current account if it's something for myself or for the house. All right. So the director's current account will actually show you a balance of how much money is owed to the director, or in some cases, there can be what's called an overdrawn director's account. So if you're a limited company and you've got an overdrawn director's account, it means that you've taken too much money out of the company and you owe it back in. If you're ever in that situation, you need to speak to your accountant ASAP because there are legal and tax problems that arise from an overdrawn director's account. All right. I had a case a number of years ago with someone who used to be a client of ours. And despite trying to teach the director that when you're a limited company, that money doesn't belong to you, it belongs to the limited company, the director continued to treat that money as if it was his or her own. All right. And their director's current account became overdrawn. So much so that it got into a six-figure situation. And so much so that the problem then, when it had to be resolved, cost the business an extra $30,000 in taxation. And there was no way around that. There's only two ways of solving the problem. It was either pay this tax or put $100,000 back into the business, which obviously, because the director was taking the money out and spending it, that wasn't possible. So if you don't have good, proper procedures and good habits in place in relation to this, your director's current account, your limited company, can become an issue. If it does, speak to your accountant straight away. So we have a look at this one in Foods Co. So Mr. J. Doe is the director, and this is his director's current account. And it shows at the start of the period, the company actually owed money to the director, $29,000. This is in the 2020 year. The director put in about £2,000. That might be money, or it might be things he's paid on behalf of the company. So he's put that money into the business. But he's also taken money out of the business, $9,679. So he's just maybe drawing money back out to be able to live on, or there's some personal expenses there, £1,676. So that means at the end of the period, the director's now owed 21. So he's owed 29 at the start of the year. He's owed 21,873 at the end of the year because he's taken back out more money than was put back in again. Okay, the difference now between profit and cash. And it's essential, and it's common for business owners to get frustrated that their bank account doesn't reflect profitability. If you're in the position where you're only seeing your accountant once a year, it often comes as a shock to find out your accountant says business made a profit of £30,000, and business owners immediately go, why do I not have £30,000 in my bank account? So it is essential you understand the difference between profit and cash, and why you can have a high profit, but that doesn't reflect in your bank balance. So you can have a situation where profitable businesses can go out of business because they're starved of cash. And a business running at a loss can actually survive because it's actually getting money from somewhere to keep throwing it back in again. So in other words, turnover is vanity, profit is sanity, but cash flow can be your reality. However, I'll also say that I have dealt with so many businesses over the year whereby they're able to get access to cash, but they can't turn it into a profitable business. A lack of profit will be a cancer to your business. It will possibly kill the business, but it may take a longer time to do it. If you run out of cash and you can't replace that very, very quickly, that's more of a heart attack situation for your business. So both of these are important, but they are completely different when you're measuring them in your when you're looking at your accounts and your financial statements. So what we're going to demonstrate on this slide is the difference between profit and cash. And let's look at some things that will appear in your books and records and go through your business bank account and decide what affects profit and what affects cash. So VAT will affect your cash. Loan repayments will affect your cash, but they won't affect your profit. They are not an expense. They are not income or expenses in your profit and loss account. So they don't affect your profits, but they will affect your bank balance. Whereas interest on loans will actually be both. Because if you're paying interest on loans as well on top of a loan repayment, then the interest that you're paying affects your profit. It reduces it. It also comes out of your bank account because you've got to pay it to whoever the financing company is. Asset purchases doesn't affect your profit. So if you buy a new van, new computer equipment, you plant machinery, that will affect your bank balance, but it won't affect your profit. And what you're hopefully seeing now is that a business with profit may have a lot less cash than what the profit's saying because it's already used the money to pay off loans, or it's bought some assets. Asset sales, if you go and sell something, that won't affect your profit either, but it'll put money back into your bank account. Whereas depreciation only affects profit. So as you can see, even if a business has achieved a healthy profit, there may not be enough cash in the bank after paying its tax, paying loans, buying new assets. That's why there's a difference. Okay, the business 101 cycle I want to talk about briefly. It's another useful way of demonstrating the difference between profit and cash. First of all, owners need to invest money into a business to get it started. Okay, so you might have savings when you started up your business that you put into your business bank account to get things up and running. What happens with that money? Well, that money can then be used to buy assets and needed to run the business. So if I think about how I started up and some savings I'd accumulated to start my accounting business, the first things I was doing was buying some office equipment, bought myself a laptop, and I was going to be using those assets in order to start generating income, in order to start, finding clients and providing services to clients and charging fees that would generate an income for the business. But you also may be in a situation where you decide, well, I'm going to also acquire some new loan finance to buy some assets, and that'll put some money into the business as well. So when those assets are then used to generate hopefully a profit in your business, you can increase your profit by growing your sales or margins. Okay. But don't forget, you've also got to pay for your overheads. So you're going to have to pay your rent, your rates, your electricity, your oil. You might have motor costs, you might have stationery, all that stuff will be a drain on your cash. But eventually the profit will turn into cash. Drains on your cash will include things like customers not paying you quick enough, buying too much stock, having to pay business loan repayments, having to pay your business taxes, or paying your suppliers too soon will be a drain on your cash as well. Gains of cash will be getting customers to pay you faster, running down your stock before you buy new stock to replace it, improving your credit terms maybe with suppliers, or finding ways of reducing your tax bill. And that's something I've actually worked on with a number of clients over the last 3 months, where we take a look at all the ins and outs of their business and decide, well, actually, there's a couple of small things you can do to put more money in your pocket, but you don't have to pay extra tax on it. The aim overall, folks, is to reduce the amount of time it takes this circle to be completed. Because at the bottom end of this, the owner needs to get paid. Maybe it has to pay off personal loan repayments if you borrow to start the business, but overall, you're looking to get your money out on a monthly basis as well. Okay, that's my 10-minute alarm, so we're nearly there. So let's talk now about the key drivers of business value. So after cash flow, business value is the next most important measure of business success. And part of knowing your numbers is understanding, measuring the drivers of business value. So the drivers might be your monthly recurring revenue, especially for service businesses. We would measure that. We would see how many clients we've got paying us by direct debit and how likely they are to stay with us for the foreseeable future. We also look at the likes of revenue growth. So how many new clients are we taking on? What's the average monthly revenue we're getting from new clients? And you can also look at your sales and profits. So those are some of the key drivers of business success for most businesses. It'll be different for every business, but we can work with you to identify what the drivers are of your business value. So in order to enhance the value of your business, first of all, you've got to document and develop and implement a clear business plan. Document your organization structure and rules within your business. You can establish cloud-based real-time reporting, which allows you to make better decisions. Review and document your systems and processes, ensure your business is running as efficiently as possible. And there's some books you can read in that as well, folks. One great book for every business owner to read is called Built to Sell. So even if you don't plan to sell your business, then you should build your business as if you're going to sell it. So it has to be fully systemized and everything documented in such a way that somebody else could come in and take over without too much hassle. That means also reducing the reliance on the owners of the business, which helps enhance the value. Easier then for the new owners to step away or bring people in to do what they're currently doing, or even to sell your business. Finally, identifying and managing risks means that they can be mitigated before they become an issue. So how does everything I've talked about today come together then in terms of best practice? Every business, I believe, should have 3 essential tools. So you should have an annual business plan, okay? Or in these times, maybe a business recovery plan of some sort. You should have an annual budget or an annual forecast, and there should be also ongoing reporting and accountability. So the reporting ensures the numbers you want to achieve in your plan and forecast are being measured. The accountability process might be some form of coaching or mentoring with the likes of myself. And using an independent coach can hold you accountable for what you're doing on a daily and weekly and monthly basis. And getting somebody to give you that bit of a push in the right direction or kick in the backside if that's what you need, then that can actually help change your results and change your whole outlook on your life and your business. Knowing your numbers is really just the beginning, folks, as it allows you to improve them, but ultimately it'll help you to achieve goals for your business. So what's your next steps? So get started now by writing down 3 actions or projects that you think are going to add value to your business. What 3 things do you believe that if you take a look at the numbers a little bit deeper, that might change the results that you're actually getting? My aim is to help you to take away from today what you've learned, and I want you to decide now what those 3 things are. So if you do have a notepad with you there, please write down 3 actions or projects that you believe are going to add some kind of value to your business. There might be 3 specific numbers that you're thinking, I think if I change that number, it's going to change my results, and what I need to do to change that number. What problems are you experiencing in your business? Identify what the problems are, but see them as an opportunity to create a project to fix them. Don't get me wrong, I have problems every single day, every single week, but I try to view it with a more enlightened, empowering mindset. A mentor of mine often uses the quote, "What's the gift in this?" What is the gift in whatever the problem happens to be? I had this just last week, whereby I had a situation, and first of all, it seemed terrible, but I kept saying what I was told to say was, what's the gift in this? And the gift is I now know how to avoid that situation arising again by taking 1 or 2 small, simple steps. And it's something that I can now teach my team as well. So there's always a gift in these things. Doing nothing at the moment, folks, should not be an option. We are going to be coming out of this pandemic phase. We are going to be in recovery mode. And I believe that the future will be a lot brighter. And I think if you turn off the news, that's probably a positive thing to do for your business as well. How can we help you? So now you know what you should be doing as best practice. Here's things we can do to help. So if you don't have a business plan or a business recovery plan, we can help you develop one. I usually aim to try and make it a 1-page plan. Sometimes it's 2, but something short and simple, which is, driving where you want your business to go. We can create you an updated cash flow forecast. And if you need to be held accountable, we can certainly do coaching and mentoring with business owners on a regular basis on their numbers and their mindset. We can create manager reports for each month to see exactly how you're doing and provide you with those reports with some commentary. Say, look, here's 3 key figures that we're seeing need to be looked at or investigated a wee bit further. We also are considering something this year called the new Cloud 360 Club. As part of the management reporting, folks, we do that for clients who have taken a cloud bookkeeping service with us. So that means we are doing their bookkeeping using Xero and other cloud apps. Which helps to systemize, automate, and just maintain their books, and they don't have to worry about it. So some business owners, I believe they should be focused on sales and marketing only, and they shouldn't be doing admin or finance. And we have a team here who will actually take over the bookkeeping, and out of that you can get your management reports. But just going on to something else we're thinking about during the course of this year is the new Cloud 360 Club. I haven't formulated the details on it yet, but it's going to be a new venture, and it's going to ask a certain number of business owners to come together monthly or bi-monthly, maybe quarterly, and we're going to cover certain topics in relation to how to improve and grow your business, and we're going to share ideas on a confidential basis between each other. And I think getting business owners with the right mindset together in the one room, albeit it might be on Zoom for the foreseeable future. I've seen that having positive impacts on every business who takes part. So it's something we're going to be thinking about rolling out during the course of this year. Last thing, we are offering people who are here today a complimentary client review. You will get a questionnaire after this, and if you're interested in that, that will be a one-off sort of session to look at where business is at now, and give you some ideas around how to change things. So that's kind of it, guys. That's it. We're sort of down to questions and so on now. I would just like to thank everybody for attending today. Thank you for taking the time. I am going to, let's see if there's any questions coming through here. A couple of people couldn't connect there. Susie's come in there and said that. Okay. Kevin, you like the cash image? Yeah, that's. I thought that it was actually something I come up with at the weekend, and I thought it would probably get a laugh anyway. So let me have a look and see if there's any questions now. So will this call be available after via link? Just that my audio is up and down. Not sure if it's my internet connection is playing up. Sorry. Yeah, look, Angie, that's no problem. There will be a recording has been made here. So we're going to dish that out during the course of the next couple of days. So you'll get an answer on that, or you'll get a copy of that in the next few days. So that'll cover that for you. Anybody else, any questions now before we close off? I know some of that content's a wee bit technical. And I know that, for most business owners, it's kind of looking at things on a once-a-year basis, but has it been useful? Is there any specific questions about the content? Okay. Let's see. Should we pay tax earlier to avoid issues paying it later? Great question. And someone who's interested in paying tax is always a good thing. So, not that you're interested in paying tax, Kevin, but I understand where you're coming from with that. Paying tax earlier to avoid issues paying it later. Well, first of all, we've got to ask the question: what tax are we talking about? So, PAYE and so on, in terms of your salaries, you pay that every month, and that's that done, dusted. Then there's two other types of tax, in particular, well, three really. You've got VAT, and then you've got either corporation tax or income tax, depending on whether or not you're a limited company who pays corporation tax, or it's income tax if you are paying under self-assessment. At the moment, corporation tax is paid 9 months after the end of your financial year. So I think part of your question is, well, look, I'd rather not have the money. I'd rather pay the government sooner, so that the money's not there anymore. You certainly can make installment payments by just simply paying HMRC corporation tax bank account on a monthly basis and putting your reference in. Albeit the only issue is with HMRC, sometimes they find it hard to allocate it when you start paying. So they don't have a facility to allow you to pay formally on account, but they say, look, if you want to, you can. However, the case may be that you pay them money and then they say, well, actually, you're due money back, and they send it back to you. It's a crazy situation. It's almost like they don't want the money. But what they're actually saying is, we want the money whenever it's due. So what I often recommend to people is, I think you've got it there as well, separate bank account for collecting tax. Would this help? Yes, absolutely. And just to prove that I'm kind of walking the walk and not just talking the talk, I have a separate bank account for corporation tax for our business. And I have a separate bank account for VAT. Now, I am actually on the annual accounting scheme for VAT. And what that means is that we do one VAT return a year, and my year is January to December. We will submit that VAT return once a year, and we have to do it by the end of February. So you've got 2 months after the end of the year to do it. But what HMRC do as well is they allow you to pay, they work out a direct debit. So they will look at your last year's VAT and say, okay, if last year you paid 12 grand of VAT, then what we want you to do now is to start paying £1,000 a month, and they'll set up a direct debit with you. So that's one way of dealing with for VAT. However, you also have to make sure that just in case your business is growing and the amount of VAT you have to pay at the end of the year is more, you should be running your figures every month as well to see, well, if I'm paying £1,000 direct debit, what if I should be paying £1,500 because my business is growing? And I have a separate bank account to put the VAT money in after I run my report, and I say, oh, but extra there, I'll put it out. So I'm only ever looking at the one bank account, which is your working account. So there's no doubt about it that having separate bank accounts to deal with your corporation tax or your income tax, and put it there and don't touch it. Part of that's down to habit and making sure you don't touch it. But if you can, even on zero, for example, what I do with clients is once they have the bank accounts set up and they move the money, we actually hide it on their dashboard on zero so they can't see it. And then it's kind of out of sight, out of mind situation. All right. So that's how we can certainly help you to deal with that. And that's what we recommend you do. Mark, definitely very useful. Proactive activity is a great benefit. Weekly, daily bookkeeping is great advantage and saves a lot of time rather than taking additional time. Yeah, and you'd be sort of well used to that yourself, Mark, in your own business and working as I know you work with all our businesses as well. Sometimes, I mean, I've been talking to a possible new client of ours recently, whereby they get their books done every 3 months, and then it's a whole mad scrambling exercise to get a VAT return done, and they're probably missing out and making mistakes. And in actual fact, I know from speaking to them that somebody made a mistake on their last VAT return because it was rushed and it cost the business £9,000. So if you actually do your bookkeeping on a very regular basis, then there's no need for all that sort of panic. It just gets done on a regular basis. Generally speaking, do it weekly, if not daily. If you're a smaller business, don't get yourself into that false economy of thinking, you know what, I'll catch up after a month. Listen, do it daily because you'll have less transactions to deal with as well. So let's see what else we've got. Louise, right? No problem, Louise. I'm glad you enjoyed it. Stephen told of a business subscription club network for owners, which puts your fees on a prepaid MasterCard. Is this a legitimate scheme? I've recently been told of a business subscription club network for owners, which puts your fee onto a prepaid MasterCard. Is this a legitimate scheme? So this would be you sign up to pay a certain amount per month, Stephen, and putting it onto a prepaid MasterCard. You've sent me a link for it anyway, so let me see if I can get a quick look at it. Give me a second, Stephen. I'm just going to dive in and look at the thing you've sent me. Copy, paste. I'll take a look at that actually and see, Stephen, in the aftermath. And I've got your email, so I will. I'll send that through to you. I just lost our connection again. Here. Okay, yeah, perfect, no problem. So that covers that. That's it, folks. That covers everything for now, Stephen. I'll have a look at that for you now because I've got it open. But look, from the comments I can see there, you've got some use out of it. Always a worry when you're doing something about knowing your numbers and there's some of those technical phrases getting bandied about. But hopefully I've sort of broken it down and spoken a wee bit of plain English, which is what we always aim to do here at Cloud 360 Accounting. So if you found it useful, that's good to hear. You'll get a copy of the recording and some further information over the course of this week. But thank you very much, folks, for joining today. If you do have any other questions, there will be a questionnaire coming out just about the webinar today as well. And I'm happy to field any more questions in the aftermath too. So thank you very much for your time, folks, and I'll catch you all again soon.